Hey everyone, I'm Alex. And in this channel, I take finance terms that might sound complicated and break them down so anyone can understand them. Today we're answering a big question. What is the stock market? In the simplest terms, the stock market is a place where people buy and sell tiny pieces of ownership in companies. Those pieces are called stocks or shares. When you own a stock, you own a small slice of that company. If the company does well, your slice can become more valuable. If the company does poorly, your slice can lose value. Let's start with a really simple example. Imagine you and a friend start selling lemonade in your neighborhood. You both put in the same amount of work and money, so you each own half of the business. A few weeks later, your lemonade stand becomes so popular that someone from down the street says, "Hey, I'd like to own part of this stand. I'll give you $10 for half of your share." If you agree, you've sold part of what you own. That's like selling your stock. Now you have $10 in your pocket that you could use to buy more lemons and sugar, get a bigger sign, or save for something else. Now here's the important part. Let's say your lemonade stand does even better. Maybe you find a secret recipe or open another stand in a busy spot. More people want your lemonade and more investors want a part of your business. Because of that, the value of each piece, including yours, goes up. If you decided to sell your share now, you could get more than the $10 you were paid before. But things can also go the other way. Imagine there's a big lemon shortage and you can't make much lemonade. Or maybe another lemonade stand opens nearby and takes some of your customers. Now, fewer people want to invest and the value of each piece drops. If you sold your share during this time, you might get less than what you first sold it for. That's basically how the stock market works. The value of a share can go up when the business is doing well, and people believe it will keep growing. And it can go down when the business faces problems or people lose confidence in it. You might be wondering why a company would even want to sell pieces of itself in the first place. The answer is simple: to raise money. Companies sell shares so they can grow, build new products, hire more people, or expand into new markets. When a company decides to sell its shares to the public for the first time, it's called an IPO, or initial public offering. This is like the company's first day walking onto the big stage of the stock market. Before that, ownership might have been limited to a few founders and private investors. After the IPO, anyone can become a part owner by buying shares. These trades don't happen just anywhere. Stocks aren't exchanged on a random street corner or in a noisy cafe. They're bought and sold in organized places called stock exchanges. You can think of a stock exchange as a huge digital meeting place where buyers and sellers connect to trade shares. It's highly regulated, with rules in place to help make sure transactions are fair. In the past, trading floors were packed with people shouting orders, waving papers, and signaling with hand gestures, just like you've seen in old movies. But that's not how it works anymore. Today, most trades happen quietly behind computer screens, where orders are placed electronically and completed in seconds. Prices of stocks are always changing, and the main reason is supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. It's the same idea as with anything people trade. The more something is wanted, the higher the price. But in the stock market, demand changes constantly because people's expectations about the company's future change. A company might release a great new product and suddenly more people want to invest. Or maybe there's bad news and people rush to sell. You've probably heard people talk about a bull market and a bear market. These are nicknames that describe the general mood of the market. In a bull market, prices are going up. Picture a bull tossing things upward with its horns. In a bear market, prices are going down. Picture a bear swiping downward with its paws. If you're learning something new so far, make sure to hit the subscribe button. I know you hear this from a lot of YouTubers, but it really does make a difference. It helps the channel grow and lets me keep making free videos like this for you. Now, a big myth I hear all the time is that the stock market is just gambling. And yes, if you're buying and selling quickly, hoping to make fast money, it can feel like gambling because you're guessing short-term moves. But many investors take a different approach. They buy shares in companies they believe in and hold them for years, even decades. That strategy isn't about luck. It's about trusting that over time, those companies will grow and be worth more in the future. These days, you don't need a huge amount of money to get started. You can even buy partial shares, which means you can own a fraction of a stock rather than a whole one. That makes it possible for almost anyone to start investing, even with a small budget. But here's something important to remember. I'm not a financial advisor. And you should only invest money you're prepared to lose. Stock prices can go up, but they can also go down, sometimes very quickly. The stock market plays a huge role in the economy. It's where companies get the funding they need to grow, and it's where individuals and institutions try to grow their wealth. When the market is doing well, it can be a sign that businesses are healthy and people feel confident. When it's struggling, it can be a sign that investors are worried about the future. That's why you hear it mentioned so often in the news. It's not just numbers on a screen, it's a reflection of how people feel about the economy. So, to sum it all up, the stock market is a system where people buy and sell ownership in companies. Prices move based on what buyers and sellers believe those companies are worth. It can be unpredictable in the short term, but over long periods, it can be one of the most powerful ways to build wealth. If you found this helpful, don't forget to subscribe and leave a comment telling me what finance topic you'd like me to explain next. Thanks for watching, and I'll see you in the next one.